this video, we'll be discussing about the itemized deductions. Should I itemize? Now, that is a very big question. You should if your itemized deductions is greater than your standard deductions. And the reason I emphasize the word should is because sometimes the IRS will force you to either take the standard deduction or itemized deduction depending on the circumstance. But how much is my standard deductions? Now, these are the numbers that you have to beat, the ones on the chart, that if you can beat those numbers, that's how you know you can take the itemized deductions. So for single or married filing separate, it's $12,200. Married filing joint or qualified widower, it's $24,400. And head of household is $18,350. So again, those are the numbers that you basically have to beat in order to take the itemized deduction. Now, this does not include if anybody is, if anybody's born before 1955, or if they're blind, and obviously if somebody is claiming them as a dependent. There's different equations for those scenarios. So this is the Schedule A, which is where you're going to be itemizing all of your deductions. I just wanted you to see what it looks like, just just as a visual, and then we'll break everything down. Medical expenses. So these are expenses that basically it is out-of-pocket expenses. So anything that, you go to the dentist office and you pay a copay of, whatever your copay is, your medical copays, any prescription drugs, any acupunctures, anything that you are paying out of pocket that the insurance is not covering. It could be even weight loss programs, depending on your insurance. If they're gonna not pay for it, you can take it as a deduction with the IRS. Now, just know that there is an exception to the rule. If you can see in line 3, which is gonna be your AGI, which is in the, if you remember from my other videos, which is your adjusted gross income. If you multiply your adjusted gross income by 7.5%, whatever that number is, that is your cap on your deductions when it comes to medical. So for example, so if your 7.5% of your income becomes $7,000, for example, and your itemized deductions for medical or dental expenses is now at $8,000. So your difference is the $1,000. So the $1,000, that is how much you can deduct on your medical. There's also a side note when it comes to medical and dental expenses. Those do not include your cafeteria plans or your flex plans. So anything that your company is giving you to spend money on, now those are pre-tax money. So you can't, the IRS tells you you can't use those as a deduction anymore because it's kind of sort of like double dipping. So because you're now those income, that amount from the cafeteria plan, you're taking pre-tax money, so now you cannot deduct it. So just know that. So either you can use your cafeteria plans, or you can deduct it on the IRS. Now here is you can deduct all of your taxes that you've paid. Now, state and local taxes, that includes your property taxes on your primary residence and also your secondary residence. You're able to deduct the real estate tax for the whole year. On line 5C, that is where you can record your taxes on personal properties, such as a vehicle that you own. You're able to, basically your car registration for the year. A portion of it is going to be your, you can put on line 5C. Now, the way that you know which portion it is, if you look at your car registration, and there is a line where the breakdown is of the registration cost, one of the lines will say in parentheses next to it, may be tax deductible. That is the amount that you can put on line 5C to deduct for your personal property taxes. Now, the second section, which is your interest paid, that is going to be your home mortgage interest, and that includes the points, if you have points that are also that you've taken on your residence. It can be also ones that you've received a 1098 for, but also sometimes the home mortgage doesn't include some of the cost in their tax forms. So you can also put that on line 8B. You can also include the points, which is either on 8A or 8C. And 8C is the ones that are not reported on your tax form that you receive in the mail for the form 1098. You can also include the insurance premiums on that as well. In this one here, you're able to deduct the gifts to charity. So any cash or check value, you know, whether it's donations or clothes to the Salvation Army, to the Red Cross, anything you'll be able to deduct. Now it's separated. Now in the first line, in line 11, you'll be able to deduct all of your cash and check payments, as long as each of the individual payments are below $250. Now, if they're over $500, the cash value of it, of each of the individual, there's another form that you would need to fill out, which is the 8283. You can deduct all of your charitable contributions there. The next few lines is very rarely that it's used, which is the casualty and theft losses. And those are if there is a huge, like a disaster losses, sometimes like during like hurricanes where there's a tremendous amount of losses, you'll be able to deduct some of those. And there's there's different other itemized deductions that you can be able to deduct as well. Now, the bottom portion on line 17, that would be when you are able to add up all of the lines that from your itemized deductions, and you're going to come up with that number. Now, if that number is greater than your standard deduction, then you'll be able to take your itemized deduction. If that number is below your standard deduction, then you could just take your standard. Thank you for watching. Hopefully this answers a lot of your questions and clarifies some of the points on what itemized deductions is. If you have any suggestions or further questions, please comment down below, or you can email me anytime. Thanks for watching.